This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Salvatore Buscemi of HRN. Harlem River Navy is a referral-only private investment platform that makes principal investments into private opportunities operated by world-class pedigreed entrepreneurs and operators. Sal, thank you for joining us.
Thank you very much for having me, Hall. It's a pleasure and a privilege.
Great. Well, let's start off with your background. What did you do before this?
It's interesting. In college, I'm born and raised in New York. Went to school in New York City, was biology and chemistry major. Could not really stand the sight of blood. Really, it was not blood. It was the holding a femur in the cadaver room at Beth Israel Hospital. And because of all the work that I did with that one surgeon, I managed to get a referral to work at Goldman Sachs in the investment banking division. And that sort of was at one point, everybody looks at, like when you graduate college, what are you going to do? To me, it was actually a very interesting fit because I had seen how my father had paid for my brother and I to go through college using zero coupon bonds. So it sort of brought out to me like the investor or entrepreneur I always wanted to be. My parents were always very, very supportive of that. At the age of 29, I started, just fast forwarding, I managed two institutional fund platforms. One was backed by a $2 billion Park Avenue investment manager, and the other one was a $1 billion real estate investment manager. And we did a lot of basically buying defaulted mortgages and notes from Bear Stearns and other banks that were going under. No different than what we're seeing today, Hall, right? And, we're starting to see that happen and turn around. But what really, really turned things around for me was the networking that I had accumulated over the years of working with these families and being able to participate in the things that I probably would never have thought of in the first place. And when interest rates started to go lower, people started to get easy credit. And that easy credit led to a lot of doctors and dentists overbidding on things that I was trying to buy. And really what I did was I turned around and I used the firepower that I used in real estate to sort of shepherd along a lot of influence and capital into earlier stage life science companies. The reason behind that is because I have two very good friends and partners who are both very, very proficient and experienced venture capitalists in life sciences, one coming from Rockefeller, the other one managing at the age of 26, the state of Texas, a venture portfolio in life sciences and later New York. And when you put this together, it made it a little more fun. So we formed HRN with other member families who are investors with us in our real estate deals to come along into the life science deals. And I can tell you, Hall, there's one thing that people don't like investing into, it's life science deals. But, we've been able to do that in a way where it's attracted a lot of attention. It is yeoman's work. However, it does pay off. There's a tremendous amount of legitimacy there, especially if one of these hit. Most recently, the last month in February, one of our companies was the youngest ever at the age of 27 and 26 to receive FDA approval for a PED, which is an artificial defibrillator that they're selling to the mass market now. And that is incredible when you think of all the cardiac arrests that are happening in youth sports today, such as high school football, I read a lot about, and even like NFL football. So we invest in world-class assets with world-class founders who have done this many times. We are not tuition for any founders. And we are definitely have escaped extreme circumstances, Hall, because, we've always invested with founders that have had gray hair and have done this many times before and have navigated extreme circumstances such as banking shutdowns and things like that. And also, they're well capitalized by best-in-class families who have a track record of investing in this stuff. If a family is a life science investor or real estate investor, they know that area pretty well. They've succeeded in it. So. And, that adds tremendous amount of credibility and creature comforts at night, knowing that you have smart money alongside you. And we do that with everything we invest into. And it's part of our value system.
Well, that's great. Well, I appreciate the recap there. So given where you are today, what excites you right now?
There's a couple of things that excite me right now. I think we've gotten into life science investing. We like it. I think that's going to be the future coming out of the pandemic. There's always going to be a reason for a therapy or a cure for something. And to me, that's, the personal impact that I wish to have and leave on this earth and to many other people is seeing how much of an impact you can make with, one therapy, one cure for a disease or something, an ailment that affects someone that you love. And What today I think where we're going is that there's a lot more excitement now, and sort of like in the distress. I'm starting to see a lot of things in real estate start to blow up as a result of increase in interest rates. And that is sort of my background, is distressed investing. And as I said before, I was overbid on stuff, had to give money back, but then I pivoted. And so what we're probably going to wind up doing now is pivoting more into some of the distress that's out there. And more importantly, I think later on is that we've already made a segue into professional sports and starting to buy some of these professional pieces of these professional sports teams, what we call statement class assets. You know, that once you own a sports team, as they say, Hall, in the UK, they knight you or bestow a knighthood on you. And in the US, they let you buy a professional sports team. So there's going to be a lot of opportunities, and I think a lot of trades that are going to happen. And, you know, from the book that we'll talk about later that I wrote that talks about this, a lot of wealthy families do not invest in crypto. They're not looking for the speculation. They're looking for the certainty, and that certainty comes in the form of legitimacy and elevation of status.
Great. Well, tell us more about the sports investing. What's new and different today than, say, 10 years ago? What do you see changing there?
Well, first of all, valuations have gone up stratospherically, number one. And what's driving that is the wider acceptance of gambling as a whole. And, you know, there's a fractionalized, decentralized, whatever you want to call it, financing out there that's going to make this much more appealing, a lot more easier to use for these fans to be able to buy into. And the second thing that makes it much more attractive too is there's an emergence of these emerging leagues. And there's a lot of attention that's paid to that, like WNBA right now. They've captured a lot more attention than they have been able to in the past, I think. And, you know, there's a degree of showmanship there, like there is on everything. But it's also the valuation of it and how widely accepted sports is around the world. It's a happy business. It doesn't lose money. They're very well protected brands. And for a lot of the, you know, 1,000th of the 1% of society, it's a tremendous store of wealth.
Well, that's great. Sound like it's making great new strides into new areas, and it sounds like it's leveraging deregulation. It used to be you couldn't do gambling in the U.S., but it seems like that's really opened up.
Well, wherever there's a need for tax revenue, I'm sure we can open up and talk about certain revenue streams to accommodate that today. And I think that's exactly where, you know, some of the states are. They have no choice but to probably allow people to gamble online.
Right. Well, I remember our discussion the other day, and I'd like to get back to it. You know, I know you see a lot of pitches and talk to a lot of entrepreneurs out there. And what do you think is the most common mistake founders make in approaching investors for funding?
They treat them like an ATM. If you've ever been to the beach and throw a French fry onto the sand, what happens? You have a bunch of seagulls coming and fighting for it, right? And a lot of these founders they do the equivalent of creepy things of like asking for marriage on the first date. And what I think, I blame like two things. I blame Shark Tank for this, number one. And I was just at an event with Kevin O'Leary last week at St. Rose here in Miami Beach. And I didn't tell him that, but I think that they've sort of made it so transactional today that it sort of turns people off, because the one thing that we live in is a very conspicuous generation, but people are still looking for that relation, especially if you're asking for people to part with their life savings or any part of it. You have to have a relationship with a real, honest, true relationship with these people. And if you don't, then I think you're putting yourself at a disadvantage, or you're not in it for the right reasons, because people will be able to see through this. This isn't like you selling a book or, you know, a car or something where it'll be forgotten about. You know, people will always remember how you treated them before and after, and building that relationship and that network and the goodwill before asking for any money is really what's the most important thing. I've recently moved to Miami, and I've been part of this because I was invited to, thankfully, to the Florida Ventures Conference. And I can tell you, there's no bedside matters. Everybody's got like the Gary V hustle, and that's great for Bitcoin and all of that stuff, but it doesn't really work when you're asking for people, you know, for $100,000 or $1 million.
What are some good techniques for building that relationship? What have you seen that has worked out there for startups?
Interactivity is the new currency here, Hall. The way we do it is, you know, we're not on Instagram all day, although we do post photos of like our winning, what we call deal toys and things like that. But I think what I do is I'm very active on email. I send emails out to people. People take email seriously. You send too much email, they get upset. You don't send enough email, they get upset. So it's a great mechanism, especially with people who are a little older, like, you know, in their 40s, who are affluent and trying to get into this, or managing the affluence of a parent. And by always being on the top of their mind, it's always something where you're going to be seen as the preeminent authority for whatever it is that you're trying to do. And I think too many times people just send these emails that sound so boring out to people. Dear colleague, dear prospective investor. It's just, Nobody needs to read that stuff. There's nothing in the Bible or the Constitution that says I need to read your email, Hal, right? So it's, you got to make it much more compelling. And that's how you do it, is by putting your charisma and personality into, the emails that you write and, just talking to these investors. It's really simple, but a lot of people don't like to do it because it's a skill set that needs to be acquired, right? And if you don't want to acquire the skill set, then you're at a disadvantage. And luck is where you have many skills stacked together at the right time, or at least that's my definition of it.
Right. Well, I've had many startups come to me wanting to get an access to an investor, and I could tell that all they were going to do is ask. We're just going to ask for money, and that's all we're going to do.
It's
embarrassing.
I told one once, isn't it embarrassing? It's humiliating to guy like me, because you become the a-hole by association, if you know what I mean. It's like, who are you to bring this guy? Who brought this cool guy in? You know what I mean, Hal?
Right. You have to be careful with these introductions because they can come back at you in a negative way. But what I noticed is he had really interesting information about his sector, which was fintech payments in that particular case. And he had done all his market research, and I found it very interesting. And I said, well, instead of going in with an ask, why don't you go in with your market research, and with no ask, just give him the ability to access your research, the trends, the numbers, and so forth. Give him a 20-minute pitch over the phone of what you've learned about the space without ask. Just give him that information. And he came back later and said he was able to get quite a few introductions that way, because people, especially investors, are always interested in learning about new market segments. There's over 200 of them out there, and there's no way to keep up with all of them. And to have somebody come and give you the condensed version of it is quite helpful. What do you think about that?
I think it's great. I think any way that you can put yourself out there where you're providing value to your investors first, whether it's through a high profile contact or an introduction, is probably the best way to do that. I've been able to introduce myself to many investors by not asking for anything, but saying, hey, I know someone who does that. I used to work with a guy who did this or something. And then that says to them that you're putting your reputational equity where your mouth is without asking for anything. There have been times where I've actually somebody sent me an email. Yeah. And I knew, I never asked for it later. And they're like, could you take a look over this real quick? And, just let me know what you think of it. And I'm like, sure. Of course, I mark it up, send it back to them. I'm like, look, this is just what I would do. They take it. And then later on, there's that reciprocity that, is always there. And so you never remind them of it, but they'll always remember it. And it's one of the things where, yeah, you want to do that, but I think you want to start building the network by, talking to these investors, but also not only doing what you said, which I think is a wonderful idea, but also seeing how you can also provide value to someone. And that's really what you do, is how do you provide value without any explicit reciprocity?
Right. Well, once a founder has something of a relationship with investors, and that's what I found running angel groups, is that you have to build a little bit of a relationship along the way. They're just not going to give you money unless they know who you are and you know them at some level. But what's your advice for founders after they get the introduction? What should they do next?
I think the real fortune's in the follow-up here, assuming that they know what they're doing, assuming that they're doing that. I think that they need to define the terms and say, look, Paul, we're doing an investment here. We're raising $2 million for this company called Thrive Biosciences, which are a case study. It's Thrive Biosciences. In order to get into it, I need to have your commitment by April 15th. There are a lot of other people who are investing into this. I can't keep it open-ended, but I would love to talk to you more about this should you think Thrive meets your investment criteria. And that's it. That's really it. Every time I talk to people, I don't always have something to pitch. I'll be going up to Palm Beach in a couple of weeks for the boat show. However, I'll just be there meeting people. And I think it's just, talking to them first and then following up second. You want to meet people. When you meet people the first time, you never talk business, especially if you're dealing with continental Europeans. They want to get to know you first. But you have to remind yourself that nobody's ever going to give you their money without giving you their time first. Exactly as you said, they want to know who you are. It's not just the background and all that they do want to spend time with you. And it's anything like this because, again, you're asking for someone to part with part of their life savings.
Well, in the sales world, they say it takes 7 touches to close a sale. What about 7 touches to close an investor? How much is that the same or different?
That's about the same, actually, to be honest with you. And I can tell you that because of the email marketing that I do and I write and I watch on, our HubSpot app over here, I can tell you that that is true. I mean, sometimes it takes a little more. Sometimes you have to hold hands a little longer. But if you're doing the right steps and you're going through this like you would a normal relationship, right? Where, you're holding hands first and then you kiss and then dinner and what have you, then it's going to be a lot better. And those 7 steps, and that really is part of the 7 steps. Sometimes if you're dealing with something that's a lot more complicated and you don't get it in the 7 steps, I would look at the way you're communicating to your investors. Remember, your investors are never going to tell you that they don't understand what you're saying. Very few of them will, or say they're not as smart as you are. And the only thing that they really know, especially angel investors at this point, is, what they see off of the mainstream media. So you have to make sure that you get into their head and say, and understand that they don't understand everything you understand. And you need to simplify things in a way where they can really understand it, probably using a story format too, to explain your case or company.
Well, I can remember a time when you could call anybody you want on the phone, but if you wanted to email them, you had to have permission, the Spam Act and all that. But post-pandemic, or even the last few years, what I've discovered is that it's reversed. You can email anybody you want, but you have to have permission to call them on the phone. What's your take on that situation?
That's actually, I always say get on the phone, right? And, when I email people, I'm looking for people to take action. The way we're legally structured is that we have to move fast because mice go where elephants can't in some of these opportunities. And I think it's definitely changed, but if they're expecting your call, that's fine. But there's nothing wrong with sending, and I do this. You can't send an email and expect people to read it. Again, neither the Bible nor the Constitution says that anyone's obligated to open the email. However, that doesn't necessarily mean, that's all that's done and they're not interested. You have to get their attention. And I do call up and I'll say, hey, Hal, how are you? I sent you an email. You didn't open it according to HubSpot. Can we talk for a second? Oh, yeah. Okay. And then I just start, going off on that. I think if you're confident doing this, and that comes with practice, things will get better. And you can, I would definitely call people to be able to contact them. Everybody likes to talk on the phone. Nobody knows who's calling today because you don't know if it's a political pollster or someone else. And every time I pick up the phone and it's a number I don't know, what happens is that it's usually a car warranty or something that really doesn't apply to me because I don't own a car. And I think, maybe just sending a text message out too is also very appropriate. When I go out to conferences, I don't carry cards with me, although I should. I want to get their contact information. So I tell them to text me their name, and then I respond with mine. And now I have their contact information, and that gives me permission to text them. And then I move into email after that.
Well, I coach a lot of startups, and I tell them you can use email and Zoom to open up the discussion, but you're going to have to use the phone and in person to close. And I think that's where a lot of people get stuck, is they don't realize I'm not going to be able to email my way all the way to a $2 million raise. I'm going to have to get out and talk to people on the phone. And if it's a big check, somebody's going to get on a plane and go meet them. They may come see me. They want to meet the team, or I'm going to go them because they don't have time to travel, but somebody's flying somewhere. And I find a lot of startups really don't have that in their mental budget for it. They just think that we're just going to email all the way. And if it's not going, well, there's something wrong with these investors. But again, to your point, the relationship has to be built.
Yeah, that's their ego, and they're going to fail. Because if they don't feel as though they have to go out there and talk to the person who holds the gold, then something's wrong. And it comes off as being wrong in their value system, to be honest with you. That they weren't raised professionally, if that makes sense, going to a Goldman Sachs or somewhere where they're assuming someone with an email is just going to very cavalier, not ask too many questions, maybe just reply in a few emails and then send wiring instructions. That doesn't happen in the real world. I think there's a lot of, especially in tech, you get a lot of people who are and life sciences too. You get a lot of people who are masters of what they do in laboratories, masters of what they do in their pajamas, doing coding, whatever tech people do, but they lack the charisma or the personal interest actually to be able to work with people on a more intimate level. And I don't mean that in a creepy way, but saying, hey, do you understand the investment? Because as I tell people, your job is an educator. You have to educate these people so they understand where their money's going and how it's coming back to them. They don't know this. Just because somebody has a lot of money, 200 million in their checking account, doesn't necessarily mean they understand real estate. Or maybe they do and they are in real estate, but they don't necessarily understand tech or life sciences and the 500 different iterations of DeFi today, right? So they don't understand that. If you said there's like 600 permutations or 600 different types of industries out there, but if you get even deeper and more granular, everybody's carving out a niche for themselves. Don't assume your investors understand that. Don't assume that they're actually going to want to pay attention, because they probably have other people who are asking them for money too. I know I get asked all the time for money, and all these wild foundation ideas that people want to come up and pitch these families to. And you got to be very protective of their time, but also be very accommodating too as well. And if it's not in your personality to go out and meet these people, you're going to be hamstringed, because problem is that people only want to do business with people who they like. And, there's a lot of things that go off during the, being physical meeting one-on-one with someone, is no different than dating. So I think, people should really look at raising capital vis-a-vis like dating, if you will, right? Clean it up a little bit, get interested, learn some table manners.
Right. Well, I get asked often about closing investors and what can they do to close an investor who's not moving forward. What's your advice for startups that are stalling out, so to speak, in the fundraise? How should they approach closing the investor in those cases?
It's interesting. I just came from a Florida Ventures conference about a month ago. And what I did was I wrote my fourth Kindle, and it's called Calling the Capital. You can get it for free by going to callingthecapital.com, but it's 20 ways to add urgency to your capital raise without sounding desperate. And in there, and as I said before, nobody likes investing in life sciences because it's all kind of boring. Nobody wants to remember high school biology or high school chemistry. And what I've been able to do is to raise millions of dollars for these hard to raise companies due to the fact that we were using sort of carrots and sticks and stories and narratives. But really the first thing that comes down to it, I'll tell you, is that a lot of people don't use a deadline. You have to deadline things, and you also have to gate things up, meaning you have to have maybe tranches or something saying if you're not in this round, well, the next round's not going to be that great. The valuation is going to be higher. You're not going to get the free toaster and things like that. And it really helped a lot of people. Actually, someone named Andrew Satz was able to raise $150,000 from some Synapse conference here because of some of the strategies that were put together. And that was really the sort of what drove me to write this book. It's only 24 pages, but it's very, very impactful as it relates to what we call calling the capital and getting people to take action, because there needs to be a fear of missing out somehow. And if you're very good at communicating to your investors what that is and what those circumstances look like, and you put it in writing so it's clear and they don't misunderstand or assume anything, you're going to have a lot more success raising money. And I'll tell you, put a deadline on everything you do. If you're raising capital, even if it's a fund or something, and just say the first tranche. You can have 4 tranches. It doesn't matter. But a lot of people go out there and raise money, but they don't have any deadline on it. They just send you a PPM and a lot of legalese. But why do I need to take action? Where's the fear of missing out, right? I mean, if this is the ShamWow guy, he'd be selling you, the ShamWow because there's only a few left. You need to do the same thing, although tactically and much more tastefully when you're asking people for investors' money. And that's exactly what I put together in that little handbook.
Well, that's great advice. I always coach people to send out updates, and in those updates, you should be showing that the funding is coming in and we're getting near the close and it's about to happen, and that'll speed up things in a great way. But in the last few minutes that we have here, what else should we cover that we haven't?
I think you have a lot of entrepreneurs right now who are probably, if we can talk about current events, who are kind of spooked about what's going on with the SVB and Signature Bank and some of the things that are happening right now in the capital markets as it relates to Silicon Valley companies being incapacitated because of a bank failure. And I will tell you that not to give up. There's always going to be capital around. There's a lot more capital available today privately than there are from banks. And when you are raising money, what I would do is I would always be raising money. I think the second rule of real estate that a lot of people don't understand, but it still applies to founders and CEOs, is always be raising capital. Always be raising capital. Real estate investors, they cease to become successful if they don't have capital coming in all the time, whether it's from their own operating businesses or they're raising it from other people. And always develop that skill set of sales and influence and persuasion. So talking to these people, because that is really the hardest job in the world, is getting someone to part with their life savings. And if you start developing that skill, like anything else, and maybe, depending to you, it's as difficult as dating, you want to develop that skill, because that is like a muscle that's going to help you, not just with this raise, but with other raises to come later. And that's really, a skill set that can really help you for life and develop something. That's something that AI is not going to take away, is that interactivity of the relationships that other humans and carbon-based life forms are really, quite frankly, striving for. We live in a generation where everybody's connected, but everybody feels lonely all the time now. Doesn't that make sense?
Absolutely. That's great advice and so true. Appreciate you sharing that with us today. So how best for listeners to get back in touch with you?
I would urge them to download my handbook for free by going to callingthecapital.com. If they have any questions or they want to, be onboarded onto our multifamily office investment platform as an investor, see how we do this, they can send an email to sal@investinglegacy.com. That's sal@investinglegacy.com. We definitely do our best to accommodate you as it relates to having you look over our shoulder and see what the big boys see.
That's great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Paul, thank you very much. I appreciate you very much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.